Hello, everyone, and welcome back to SALT Talks. My name is John Darcy. I'm the managing director of SALT, which is a global thought leadership forum and networking platform at the intersection of finance, technology, and public policy. SALT Talks are a digital interview series that we launched during this work from home period with leading investors, creators, and thinkers. And what we're really trying to do during these SALT Talks is replicate the type of experience that we provide at our global conferences, the SALT Conference. And what we're trying to do is provide a window into the minds of subject matter experts, as well as to provide a platform for what we think are big ideas that are shaping the future. And today, we're thrilled to welcome you to the first episode of our Pandemic Venture Investment Series, which is being presented in partnership with OurCrowd, a leading global venture investment platform. In this series, we're bringing top entrepreneurs, investors, business leaders together for deep dives into the challenges and opportunities arising from the pandemic crisis. Today's episode, Investing in the Pandemic and the New Normal, features Steve Krausz, managing partner of U.S. Venture Partners, and Alec Ellison, the chairman of OurCrowd U.S., with an introduction by John Medved, the chief executive officer of OurCrowd, who joined Anthony yesterday for a SALT Talk as well. Just a reminder, if you have any questions during today's talk, you can enter them in the Q&A box at the bottom of your video screen. And now I'm going to turn it over to John Medved again to provide a more detailed introduction into the series and today's talk.
Thank you, John. It's great to be here with the SALT Talks. This is a very, I think, important beginning of a new series called the Pandemic Venture Investment Series. We are attempting here to cover a broad range of topics about the investment opportunities represented by the crisis that we're all living through. And it's both focused on medical issues and ways that we can combat the pandemic directly, but also what we call the new normal. So there will be sessions in the coming weeks, once a week, about mobility, about artificial intelligence, about ag tech, and about a variety of other great topics. So please come back and see us. Just a few words of introduction about OurCrowd. OurCrowd is the world's largest venture investment platform. We're managing close to $1.5 billion of commitments. We've made over 220 individual company portfolio investments where you, as an accredited investor, can actually choose which one you would like to join us with. Each of these investments are curated by the OurCrowd investment team. We invest our own capital, and then we set terms, sit on boards, and open these investments to our crowd. We also offer, at the moment, 22 different venture funds. And today, we're proud to start off this series by featuring one of our investments in the spectacular fund known as U.S. Venture Partners out of Silicon Valley. We were fortunate enough to be a limited partner in USVP number 12, and we're welcoming today my good friend, full disclosure, we went to high school together, Steve Krausz, who's the general partner, managing partner at USVP. Steve has been there literally since, I think, 4 years after the fund started in 1985. So about 35 years of venture experience. The fund, USVP, is invested primarily in Silicon Valley, but also very, very strongly in Israel. And they include in their portfolio great companies such as Checkpoint, Box, GoPro, Mellanox, Trusteer, Imperva. You can go on and on. It's a great team of people who we're close to. I also, another full disclosure, I think my first big venture capital investment almost 30 years ago was done together with them in a company called Compugen, which became $1 billion company in bioinformatics, and we're big fans of U.S. Venture Partners. To interview Steve Krausz and to get his unique perspective, we're joined today by my partner and also very good friend, Alec Ellison. Alec is the chairman of OurCrowd in the United States. He has a very rich, decades-long background where he was the president of Broadview International. Broadview was perhaps in the day the leading investment bank focusing on technology companies. That's where I met him the first time. He traveled to Israel, did more transactions in Israel, frankly, than any local Israeli investment banker. Broadview was later acquired by Jefferies, where Alec then became the vice chairman and the head of their technology investment banking group. And today, as I mentioned, he is the US chairman of OurCrowd and a big part of our recent success. So I'm going to turn it over to you, Alec, to talk to my good friend Steve. And I think the viewers are in for a treat today. Thank you.
Thanks very much, John and Steve. It's really a pleasure to be able to have this discussion with you this morning. And again, welcome to all of our participants. So Steve, let's jump into it. We're approaching 8 months into this pandemic. You've been around long enough, as John says, to have lived through quite a few crises. Even before that, I guess crash of '87 was probably the first one you went through. What do you perceive as different about this crisis from the perspective of being a venture investor?
Well, thank you very much, and I really appreciate the introduction and the kind words, Alex and John. And the difference here, and it's a dramatic difference, is that the venture community now is a very global community. It has a footprint that spans, all of the continents. At the time when I entered the venture industry, and it very much was a cottage industry then, you could probably fit all of the VC firms into one room. And in '87, it was an industry that had a few tens of billions of dollars invested overall. And what happened then and what happened again in 2000 and then again in 2008 were really a fundamental crisis of liquidity in both our industry as well as in the public markets. So what is certainly different now is the industry spans all geographies, and it also has sources of capital that it didn't have in the past. It also has a group of individuals that are highly diverse, and but what still remains true is that the crises like these really shake the industry to its core and prove to be a real test of the teams that we invest in. What I would say is going to be different this time is that fundamentally the structure of work and the structure of the kinds of industries, the supply chain, how people think about their investments in terms of the broad diversity is going to be very, very different. In past crises, most of us burrowed down and tried to extend the life of the capital that we had invested, but we didn't change strategies dramatically. This time, I think the strategies are changing quite a bit. But as you point out, some of our best investments have come out of these periods of extreme stress in the markets. As a matter of fact, one of my very first public companies, a search company called Verity, we invested in just after the '87 crash. And then after the 2000 crash, we invested in Perva and Guidewire, which became two public companies. And during the 2008 and 2009 period, we invested in Trusteer and Box. So those were, really opportunities coming out of those kinds of crises. But this one will be different because of the importance of the venture capital.
Well, so picking up on some of the opportunities you had in the past, largely those were financial crises,
yes.
Crisis of liquidity, as you said. We almost had a financial crisis here in March, which was very scary, very, very rapid. Seems to have been, at least for now, put on hold. And frankly, the recovery, I think, has surprised many in terms of the public equity markets. But it feels like this time we're dealing with a shift with the economy. Much has been made of the acceleration of digital transformation. I think it was back 6 months ago, the end of April, where Satya Nadella said that we'd seen 2 years of digital acceleration or digital transformation in 2 months. A quarter later, he talked about technology resilience or technology transformation being the key to business resilience. I didn't have anything quite as quotable on his earnings call earlier this week. Do you think we've seen 7 months or 8 months in the 8 years of digital transformation, or do you think it was more of a quick acceleration and now we're kind of back on the old trajectory just a few years forward?
Well, I think what's changed is the attitude of company management about how quickly they have to make their transformation to a more digital footprint across the globe. So management teams are wrestling, and I was listening at the JP Morgan Technology Conference yesterday where Jamie Dimon was talking about how, his organization has thought about how many people have to come to the office, how it has to reach out to its customers, what consumers are going to be doing differently. So that's a fundamental shift. And I think it, though, for the most part, at least to date, has been playing on trends other than the work from home that were already underway. And that has to do with, cloud, the transition to cloud, the transition to a digital economy as far as financial services, the change in logistics systems, and some of the changes that were already starting to happen in healthcare. And we can talk about that a little bit more later. But I think that the impact of this transition, because venture and technology plays a much more important role across the globe, this time will be fundamentally different from past changes. And the digitization of the world economy is going to be enormous. Now, I think what remains yet to play out, quite frankly, and I don't think anyone appreciates this, is we were on a long-term path of improving economics for many people across the globe, bringing many people out of poverty, many people into the middle class in China and elsewhere in Asia. Africa was improving. I think we have seen a fundamental jolt to those economies. And I don't think yet we have a prediction on how that's going to play out. I think it's going to, whatever trends we started will be accelerated, though, that I know.
Yeah, I mean, what you're getting at is a lot of the so-called COVID casualties, hospitality, travel. Some of these are very people-intensive types of businesses and these are in many cases, whether it's in developed economies or developing economies, more able to lift up masses than the so-called pandemic plays, which tend to be highly knowledge intensive, everything from Zoom that we're on now to NVIDIA to the mega caps of Apple and others. So, as you think about your own portfolio, are you seeing any bifurcation yourselves in terms of COVID casualties and pandemic plays?
We have. I think that, if you were to sort of look at it and make, some broad sort of statements, anything that was related to accelerating the digitization of healthcare. We've been participants in healthcare IT for quite a while, but we have seen those companies do quite well. As the pandemic sort of reached us, companies like Omada, which deals with dealing with diabetes and the management of treatment of diabetes from the technology point of view. We've seen anything related to online e-commerce, primary, which allows young parents, to buy clothing for their children in a fashion that's quite predictable. That's exploded as people have, left stores and moved towards e-commerce for practically everything that they've done. And some of our enterprise software companies, quite frankly, those are the ones, a few of them actually have struggled, things in the ad tech space, companies that are dealing more with traditional marketing, automation kinds of plays, and even sales, as the entire sales industry has.
Do you think that's because retailers or consumer companies have had less budget, or more of a fundamental shift beyond that?
I think it's part of it is because retailers have had less budget. I think another part of it is that the way in which companies and enterprises have reached out to their customers and managed their sales forces has changed. You don't have a lot of salespeople in the field anymore. You don't have the same workflows that you once had, where people had to travel, or the channels that you did marketing in or advertising in have changed dramatically. So while digitization will allow you to make those shifts quickly, the near-term hit in terms of how these budgets are spent and how these tools are used has changed quite a bit. So those have really seen a dramatic effect. Now, fortunately, we haven't played in areas that have been particularly hit by large capital budgets going into into travel or into hospitality. So we've managed to avoid.
Do you think you avoided it? Was that more luck, or it was an area you didn't really like that much beforehand for whatever reason?
It was more of an area that we didn't feel matched up with our skill set. As a firm, we've always believed that the partners and general partners at the firm should understand the industries that they're investing in very well, where they have sort of deep and networks that they can pull experienced executives out of and people out of. And so that wasn't an area that we understood well. Having said that, years ago, just to show you how venture firms change over time, we did a lot of physical retail stores. I mean, we were starters of Ross stores and Jim.
Of course,
yeah. We had Avia running shoes. We had a terrific franchise. We moved that to e-commerce, but it really has changed over time. And I think every venture firm has to have that kind of transition as the world around it changes.
Good. Sticking with enterprise software for a minute, where you said there has been occasionally some struggling. Enterprise software is about as sticky as things can be. In fact, the pandemic is showing that enterprise software, either whether it's a maintenance or a SaaS model, is probably stickier than your rent.
Yes, it is.
You're going to pay that fee to keep your company up, and you are glad to not have to pay the rent. We've all learned that now. So a little surprised to hear that the enterprise software companies are struggling. Is it more that they're struggling to grow as opposed to maintain their customers, and that growth requires some face-to-face selling, and that's what's slowing the growth? Or is there something different at work?
No, let me be clear. It's only in specific areas. And what I said is it's the ones that had served channels that directly went after sales as traditionally done, or the distribution of marketing dollars as traditionally done. And I think that also what is happening there, as what's happening throughout technology, is the winners are really winning. And whereas it used to be where you would have 3 or 4, it used to be that the top company, people would say top company got 50% of the business, number 2 would get 30%, and if you were 3 or 4, you might be able to survive, and everybody else was gone. It much more is winner take all, and it's I think the winners are going to take 70 or 80% of a market, and that's the challenge, because I think that there's less opportunity sometimes, and that's a challenge in the industry because there are so many companies being started. So it is a winner-take-all economy right now, but it's also one in which innovation is happening all the time. So you can knock down, the big dogs in any sector. I won't say easily, but you can do it with great technology and great people.
Let me stay with that for a minute. You can knock down the big dogs. A lot's happening concurrently of the politically questioning the dominance of the big five that now have half of the NASDAQ 100 market cap. All companies founded 70s or later, Apple being the youngest, I guess, Apple and Microsoft in the mid 70s. So Apple, Microsoft, Amazon, et cetera. Do you really believe that you've got companies in the Valley that can challenge the Goliaths?
Well, there are a few names where their size matters and brand matters to such an extent that I think that they're going to last for a very long time. IBM had a run of about 100 years. I'm not making any predictions, about Microsoft or Amazon or some of the really big Goliaths as to how long that'll happen. But I really do believe that innovation has just a tremendous ability to challenge some of the big Goliaths. However, we are right now in a period where capital matters a lot and brand does matter a lot. And these companies are still very young, and the teams that are running them are still teams that started them to a large degree. I mean, look at Amazon, look at Salesforce. There's a lot to be said about, having that kind of managerial expertise that's used to dramatic change. However, having said that, look at Snowflake. We're not investors in that company, unfortunately. I know some of the board members well. Terrific company, and they have really changed and are challenging some of the big dogs. I mean, you look at SAP their recent earnings report was very disappointing. I would never.
And Mark Benioff rushed out to say it's a different model. Don't hit us.
They are a different model, but they were, they were certainly a very dominant player. And I think if anybody had looked back 10 years ago, they wouldn't have seen or predicted that there might be changes like that. Now, again, a lot of it does go to leadership, and I think when McDermott left there, it made a big difference.
Mm-hmm. Let's go back to healthcare for a minute. Have you changed your allocation to that sector over the last 6 months?
This is interesting. We have always been, unlike many venture firms, we have always been a participant in healthcare, and we have always been a participant in biopharmaceuticals as well as devices. And the ratio in the past was roughly 80-20. And over the last few years, because of the expertise of my partner, John Root and Casey Tansey, and John is an MD and a neurologist. He understands the changes going on in the pharmaceutical industry quite well. And Casey was a former CEO, but also what's going on in the economy with regard to digital health and the ever increasing change in the entire way that the U.S. healthcare system is both paying and delivering healthcare. So we're probably more like 70-30, 65-35. Depends on how you describe the health.
The health being the 30 or the 35.
Yes. I'm sorry for not being clear on that. With the healthcare and the healthcare IT side of it increasing quite a bit. So, it's, I think it's going to be an area, since it's in the upper 20s as a percentage of the U.S., GDP predicted over time with the aging of the population, but also with the further involvement of people in their own health management. And we're investing in that area, quite successfully. And we've made a few investments there.
Any specific ones you've made in the last 6-8 months that you want to flag?
I mean, I think that one of my partners, Dafina Toncheva, invested in a company called Optimize, which does remote patient monitoring. And we think that that's going to be an area, because of all the devices that we're wearing, because of the automation of healthcare records, and also because of the involvement of people in their own health management. Remotely managing healthcare, I think, is going to be a major trend in the healthcare industry. So that's one that we invested in recently and feel real excited about. That was during the pandemic. We've done a couple of others during the pandemic also. We've long been a player in cybersecurity, and we've been very successful. As John kindly mentioned, we were investors in Checkpoint at its very beginning.
I remember well from
and I continue to invest alongside Shlomo Kramer and his most recent company, Cato, which also plays to the pandemic. Cato is a company that it really addresses the fact that the way that the networks around the world were built in the past, heavy on networking equipment, heavy on networking protocols that have changed over time. Cato allows you to do all of what we're doing today around the world very inexpensively and yet be very secure at the same time.
Was this at a seed or A round stage or a little later? Or?
We were the first institutional investor alongside Aspect, which is now Acru. So that was the Series A, and have been joined since then by Greylock and Lightspeed, a couple of great partners with us and people we like to work with. The investment that we did just recently was in Cyber Hunters, where my partner Jacques Benkowski sits on the board. And Cyber Hunters is a company that is, or Cyber AI, as many know it as, is a company that does extended threat detection and response. And what I mean by this is it allows you to do threat detection in a dynamic way, in an autonomous way. You don't have to have all these scripts. It figures out for itself what kind of threats you're seeing. And believe me, that's been an explosion since the pandemic hit. Another healthcare.
It was also exploding because of 5G rollout, which just creates so many more devices on the edge too. Correct?
Absolutely. And the 5G really hasn't hit yet. It's been talked about quite a bit. I know that certainly Apple's depending on it quite a bit, and it's going to dramatically change everyone's experience, on the internet and the way that they work with technology. What it's also going to mean, though, is that again, back to our earlier point, that some of the real big dogs are going to have an opportunity to see some exciting new startup companies go after them. And even though much of infrastructure as it relates to equipment and semiconductors has not been a sweet spot for a while for us because of the capital intensity, there is so much capital now that's available, both in venture from the seed stage to the Series A, to the later stage venture funds, but also private equity firms are getting involved. You're now seeing the rise of SPACs, which is really just a way for large pools of capital, to invest in startup industry.
Zero interest rates do pretty interesting things, don't they?
And then zero interest rates help quite a bit.
Yeah. Well, they make SPACs more economic and the like.
And just the flood of liquidity that's coming, from all of the central banks around the world. And it's hard to see that changing, at least over the next couple of years. And we could have a different discussion about what it means.
So floods of liquidity typically impact valuation. We've certainly seen valuation bifurcation in the public market. Are you seeing major changes in valuation in your markets since March? And if so, is it altering the stage at which you're focusing?
Well, we have seen valuations increasing now for the last few years. I mean, if you go and U.S. Venture Partners is primarily a Series A. We're not a seed investor, but we're primarily a Series A, which means from our definition, once there's a little bit of product market fit shown. And so valuations have about doubled during the last 2 years, and from where they were before in the later rounds. In the Series A, they have gone up maybe about 50% or so. In the seed stage, it's been flatter, which historically actually has been a pattern we've seen in other periods of crisis, where the very, very early stage was hit the hardest. The later stages didn't see the kind of valuation increase, but this time they are, and I think that'll probably adjust. I can't quite honestly. It follows public markets, all the
right. Yeah, doubling sounds like a lot until you look at Amazon and Apple, right? Or Apple in particular, triple.
Right. I mean, again, going back to the JP Morgan conference yesterday, Mike Millman put up a couple of slides, in which he was showing that the market cap, if you're talking about for fast growing companies, was now 20 times revenue on the recent IPOs, and also on some of the recent public companies, for companies that were growing well over 30%. and about 13 times revenue for companies that were growing between 20 and 30%. Those are astronomical. That used to be PEs.
Well, again, it's what happens with zero interest rates. That terminal value in the future doesn't get discounted so badly.
Right. Exactly. Right. So it is, it does have echoes of what we've seen before, but I think the firms that have been around for a while and the partners that have been around for a while know how to manage through that. So what we've done is during this period, we've raised a lot of capital for all of our early stage companies. When the money is available, we take it, and we tell our companies, rather than the traditional 1 year to 18 months, they better have money for 2 years plus. So
right. The worst thing to do is run out of money.
You never want to run out of money.
Anything you're doing, your firm's doing that you would characterize as contrarian to your
I would say this. I would say that if you look historically at venture capital, what has been contrarian has been our commitment to some of the healthcare areas that venture capital have historically pulled back from a little bit, and that was particularly medical devices. And because medical devices were seen as firms that had to go through the FDA cycle, also had to have, phase 1, phase 2, phase 3 clinicals, and were very expensive and very capital intensive with modest size markets. But we've remained active investors in that space and, continue to make investments in that. In fact, we made an investment in that space recently. That was one called Krausz, which my partners have done, which is a patient-specific, a design for a vertebrae implant to solve for ruptured discs and the like. But it's patient-specific, So you're putting together all the technology that allows you to build essentially a disc for a particular patient and put it in their bodies. And, that's the kind of thing that, many firms wouldn't have even touched in the past.
I tend to agree. A lot of firms have avoided the area because of the regulatory clearance, but devices tends to be easier to clear the FDA on than therapeutics. It would appear to many that,
but they also have gross margin attached to them and distribution attached to them. That's a lot more difficult than therapeutics and training.
Oh yeah, absolutely. Look, therapeutic companies can be worth billions before they even have their clearance or their approval rather, and aren't being sold at all. But the pandemic is clearly accelerating elements of the speed of approval. Do you think that is a secular trend, or that is likely to just be pandemic specific, and we'll see a reversion back to a little more of a slow-paced regulatory clearance environment on both the devices and on therapeutics?
I would say that what we have learned from past disruptions like this is there's no going back once there really is a change, and a change that is merited because you have some reasons, and in this case, the reasons are you have a lot better analytics. The hard part is still the onboarding for trials. I mean, we're seeing it today, but look at how fast, in COVID-19, we've been able to onboard, 30, 40,000 people or more for some of these trials. So I think we're, because of the digitization, we're learning how to identify, how to track those people, how to contact them, and how to enroll them. And there's so much pressure to improve that cycle that I don't think we're going to go back. Now, it doesn't mean though that we're going to, give up protecting patients by doing it properly. But I think that the way in which we process it and the way in which the FDA reviews and makes their approvals will accelerate. Plus, you have more involvement now from, competition from China, competition from Europe, and I think that will only make things better from the point of view of putting some pressure and fire under people's seats here to get stuff done.
You made reference to capital intensity. I want to turn to a segment that I don't think your firm has been active in because of its capital intensity, which is space commercialization.
Yes.
And I think I explained to our viewers your own personal background early in your career.
So yeah, early in my career, I was a double E out of Stanford. Back in my, my passion, I had a lot of interest in space because my father actually started a company that made deep space antennas for tracking the early Apollo programs and Mercury programs before that, and also for intercontinental ballistic missiles coming down the Kwajalein. And then I worked at NASA. And at NASA in the 70s, that was the time when Viking was first landing on Mars, and that was very exciting to watch. So I've always watched the space area well, and I have personally gotten involved with a group called B612 Foundation, which is run by a former astronaut, Ed Lu, and Rusty Schweikert helped to start it. And that tries to look for large life-ending events from asteroids. And so they do some terrific work now. Originally, they were going to put a bird into space that would be a solar orbiting, but now they're managing a lot of the data coming from smaller satellites. So again, there was an idea that changed too. They originally felt that they had to put something up in space, and now they can use all these micro satellites that are being put up by many venture-backed companies and some of the best entrepreneurs we're seeing who share my passion for all things space.
So you do believe this actually will be an area where we'll see more venture because capital intensity is declining?
I do believe it's going to be an area because the need for capital to do some of these things, especially when it comes to low Earth orbit and things around our planet, are becoming reachable from the venture pool of capital that's available. But there's a lot more money that is available in some of these areas that can take it all the way. And again, private equity firms. Large defense contractors who are looking for other ways, to add to their business, and public-private partnerships. So, but you do need a big fund, and our funds, tend to be in the $350, $400 million range, Series A, is because that's where, we really think the best bang for the buck in our expertise is, and we like that space. But if you have $1 billion fund or a multi-billion dollar fund, heck, go for it. My hat's always off to my good friend, Aaron Price, who invested in Tesla. And then he followed up in SpaceX. And so I'll give him a tip of the hat to Ira. And he just has, he just has the conviction and the vision that I'm a little reluctant to step out. My partners would probably whack me down as trying to stay on strategy, Steve. But we do that all the time.
I know we have about 5-6 minutes left. Before going to a lightning round of questions, I want to pick up on what you just made about your firm. Your firm has stuck to its knitting. You're on fund number. What number is it now?
12.
12, right? As John said at the outset.
Hold on, my lights just went off on me.
Okay.
That's because my wife has put in these timers that if nobody is moving around and it's still nighttime out there, she wants to save. Anyway.
So you stuck to your knitting.
Yes.
Many of your colleagues' firms in the Valley have not. They've got bigger firms. They've set up all different size firms, stage firms. Why is that? It's obviously served you well, but that's been a bit of a contrarian play in and of itself, correct?
That's true. And I think that comes from a couple of things. One is we do have from a strategy point of view, we think that, good venture investing comes from investors who have been in the industry, who know the industries well, that they're investing in, and choosing opportunities that have a multi-decade capability to do well. And so I think we've been fortunate enough to pick areas in IT and in healthcare that really are, multi-generational actually in their appeal. But we also, we did have larger funds back in the 2000 period, and both in terms of personnel and also in size. We were investing basically in the same areas, but we realize that it's very hard to do, 3-4 times your money on very large firms unless you have a very fortunate capital cycle and market cycle playing with you. So, when we know how to do what we do, and we do it well, and we're very selective and very careful in, bringing on new partners and developing them. And we think that it, works for us. Other people have done a wonderful job building large platforms, and it works for them well. I mean, look at what the guys at Andreessen Horowitz, who I respect a lot, and Lightspeed and NEA have done. NEA, was started at the same time that we were, more or less, and they've really developed a much more multi-asset category. But I think that for us and for our LPs, they know what they're getting when they invest with us, and they've had good returns for 40 years now. So we're
so being early stage makes you particularly well. You're all firms are dependent on the management teams, but early stage maybe even more dependent. So how is your evaluation of management teams and CEOs in particular had to change in our more virtual environment now with Zoom and otherwise?
Yeah, I would say that is an area that we feel very strongly about in terms of sticking to our knitting, and as you would put it, in terms of really wanting to sit down and get to know our teams and their ability to hire teams. So from that, what that has meant in terms of what has changed is we're leveraging even more some of the teams that we know personally or have close relationships with, because it's, despite the fact that this means of communication works okay, hiring a full management team over Zoom, people are still people. It's tough, to really get to know what's at the heart of a person's core and identity. How their value system, how they think about people, how they think about hiring, and also management teams. We rely on them to hire the teams below them, and so we're relying more on people that we've seen that have done it successfully in the past than perhaps some others who are willing to do the entire. We've done a few things entirely over Zoom, but it's mostly through relationships that we've already had, or people that have relationships with those people. So that's changed a bit, and I think that it's probably going to remain the same for at least this investment cycle.
So speaking in the last minute or two of getting to know someone better, for our viewers to get to know you better, just some quick lightning round questions, quick answers. Last book you read for fun?
Actually, I don't. There were two that I just finished. One was Just Mercy, which is by Brian Stevenson. And during this period, that what's going on in this country and around the world, I thought it was just a terrific book. He, is with the Equal Justice Initiative, and it's well worth reading. And then one, my partner, Erwin Fetterman, and I both share a love of history. And years ago, I shared a book on the war to end all wars, and he followed up with a book called The Bridge on the Drina. That's probably one you've never heard of before.
No.
That was by it was written based on by Ivo Advik, who is a former Yugoslavia ambassador to Germany, and it was about the decline of the Ottoman Empire in the Baltics. I have a real fan, the Balkan states rather. I have a real interest in history, and so it was written about the end of the Ottoman Empire and what happened in the Balkans. So
speaking of history, most historical figure, alive or deceased, you'd most want to have dinner with?
Boy, the alive or deceased that I most want to have dinner with. I would say that, that really, especially at this moment in time, it would probably be Jefferson. And the reason is I want to know what the hell he was thinking when he wrote the Constitution of the United States the way he did. There's a whole bunch of things he could have cleaned up. Anyway, but I think he's a perfect example of an individual who you admire an incredible amount of what he did, and yet on the other side in his personal life and some of his thoughts, you think, how do those two ideas exist in the same brain?
Right. Here's a real quick one for you. What kind of smartphone do you use?
I have an iPhone 11.
Okay, 11. All right, reasonably current. And
Yes.
then finally, company in your portfolio most likely to become a household name.
A household.
I know you love. Yeah, so it's not like you don't love all your children, but it's like a company that's most likely for
Well, I
the
would
broader
say
world
I would
to
change
come
it a little differently.
Okay.
It would also become a household name in the world in which I travel, because again, I'm on the tech side. That would probably be Cato. I think has a chance to be a real leader and ring the bell.
Just for our viewers again, describe Cato again. You mentioned earlier.
Cato Networks, founded by Shlomo Kramer, who I've invested with a number of times, and an Israeli entrepreneur who's probably been the best security entrepreneur that I've known and watched, and there have been quite a few that we've invested in. What they do is they really manage the change in the network that you run over. So the entire software stack is going to run in their environment, and they're going to allow you to connect all of your devices, keep them secure, keep them well managed at a much lower price than you have done in the past. So I think that they have the ability to be the software and the backbone that runs all of what we think in the past of telecommunication systems, whether it be the AT&Ts of the world or the Comcast of the world. I think that the software and the architecture, they could be the heartbeat of that.
Terrific. Thanks so much, Steve. So you heard it here first, Cato. To all of our viewers, thanks so much for joining us. And Steve, you're really a great far-ranging discussion this morning. I think I go back to you, John, to wrap it up.
Thank you, everybody, for tuning in to today's SALT Talk. This is the first episode in our Pandemic Venture Innovation Series. We're very excited about this partnership with OurCrowd, one of the leaders in the crowdfunding space for venture investments. So we're very excited. Thank you also, Steve, for joining us. And we'll look forward to hopefully meeting you at one of our in-person conferences here in the near future.
I appreciate that, John. I apologize for the coloration here, because I am sitting here in the dark in California, and this room just happens to have a very yellow light. My son is just going to gag when he sees me with the complexion that I have today, especially considering where we are right now in the election cycle. But I've really enjoyed it, and we're usvp.com. It's very easy to find us, and please reach out if you have any questions, and thanks for the follow-up. And I've very much enjoyed the partnership with OurCrowd, and I thank Alex for leading me through this conversation, and my good friend John Medved for all of the support that he has given us and the exciting companies that he's started. I think it's a great idea. So OurCrowd.com, we currently probably have a dozen individual companies on the platform, and always several funds as well. So please join if you haven't already. Thank you again, Steve and John.
Yep, thank you, Alec.
Thank you. Good night. Have a great day, everyone. I can go back to sleep now?
Absolutely.
Thank you.
Thank you. All right.